Welcome back, traders. Today's chart is a perfect lesson in patience and the power of key levels. The price was in a clear downtrend, eventually finding a significant area of support. This key level, as marked, is where buyers historically step in, causing the price to bounce. However, the smart move here isn't to buy the bounce blindly. The mantra on the chart says it all. Waiting is the key. We waited for a confirmation that the sellers were regaining control at this precise level. That confirmation came in the form of a classic bearish engulfing candlestick pattern right at the previous support, which has now turned into resistance. This pattern signals strong selling pressure and is our entry trigger. We place our stop loss above the engulfing candle and the key level, and we patiently let the trade play out, processing the information the market gives us. This entire setup underscores a critical concept. It's not about predicting the market, but about reacting to clear signals at objectively important levels. So, we've identified our bearish engulfing pattern for a short entry, but how can we increase our odds for a long trade? This is where the concept of trading confluence becomes your most powerful tool. Think of confluence as building a case where multiple technical factors align, strengthening your conviction. Let's break down a classic bullish scenario. First, you have structure. The price is at a major support level, a place where buyers are likely to defend. Now we add our trigger, a specific bullish engulfing candlestick. Notice the precise anatomy. The bullish candle opens lower than the previous candle's close, showing initial seller dominance. But then it engulfs the entire range of the prior red candle and, crucially, closes above the previous candle's open. This shows a powerful shift from selling to buying pressure. When this strong reversal pattern appears right at a key support level, that's confluence. You're not just trading a candlestick. You're trading a candlestick at a place where it should matter, dramatically increasing the probability of a successful reversal trade. Now that we understand bullish confluence, let's flip the script and apply the same rigorous thinking to a sell setup. Our trading signals hub is highlighting a classic scenario for finding a short opportunity. First, we identify the broader context. The market is in a clear downtrend confirmed by a break of structure, BOS. Our goal is to find short opportunities on retracements. The key area to watch is this liquidity area marked by a huge spike in price. These wicks represent a pool of stop-loss orders from traders who went long. For us, this becomes a potential trigger zone. We anticipate that price will rally into this liquidity area to sweep those stops. Our plan is to place a stop order above this area, waiting for that liquidity grab to occur before price reverses and continues the underlying downtrend. Our first profit target, TP1, would typically be at the next lower level of support. This setup perfectly demonstrates how to use market structure, liquidity, and order flow to plan high-probability sell trades. Before we can consistently profit from these sophisticated liquidity and confluence setups, we must master the basic language of the market, candlesticks. Our trading signals hub breaks this down perfectly. Think of each candle as a battlefield between buyers and sellers. The real body shows the open and close, who won the battle within that time period. But the critical information is often in the shadows, the wicks. The upper shadow tells us that price moved higher but was aggressively rejected. As the chart states, the market rejects price above this point. Conversely, a long lower shadow signals that the market rejected lower prices, pushing them back up. When you see a long upper shadow near a key resistance level, that's a potential sell signal. A long lower shadow at support, a potential buy signal. This is the micro-level evidence that confirms our larger theses on structure and liquidity, allowing us to enter trades not on hope, but on clear evidence of rejection and momentum shift. Now let's get tactical and talk about one of the most critical aspects of trade execution, where to place your stop loss. This chart gives us a clear and logical rule, especially in an uptrend. The principle is simple. In a healthy uptrend, the market should make higher highs, or HH, and crucially, higher lows, or HL. Our entry here is an entry above zone breakout, confirming the bullish momentum. But the real key to preserving capital is the stop loss. As the chart states, your SL should be set at the last highest low. Why? because if price breaks below the most recent significant higher low, it signals that the core structure of the uptrend is broken. The buyers who were previously stepping in at that level have been overwhelmed by sellers. This isn't just a random level. It's the objective point that invalidates your trade thesis. By anchoring your stop loss to this market structure, you're not just protecting your capital, you're letting the market itself tell you if you're right or wrong, ensuring your losses are small, logical, and structured. Now let's zoom in and talk about a precise, high-frequency strategy for those who operate in the fast-paced environment of the 1-minute chart. This framework is all about aligning micro-movements with a higher time frame pulse. The key is to watch the movement in 1 min in relation to the movement in 5 min. The chart illustrates a consolidation phase, where the 1-minute price action is coiling within the broader range of the active 5-minute candle. The strategy gives us 2 specific entry triggers. First, when the 4th candle touches you, do take the position on the next candle. This suggests an anticipation of a breakout as the consolidation tightens. The second, more conservative trigger is, when the 5th candle touches, you can enter to retract it so that it closes with the 5-min candle. This likely means entering on a pullback or retracement within the 1-minute range, aiming for a move that aligns with the closing direction of the overarching 5-minute candle. This approach is about using the 5-minute candle as a directional filter, and then using the numbered sequence on the 1-minute chart to time your entry with precision, capturing a swift move as the smaller time frame momentum converges with the larger one. All right, we've identified our setups and our stop losses. Now let's bridge the gap with precise entry techniques. This is where many traders falter. But the framework here gives us 2 clear, disciplined methods. The first technique is the aggressive approach. Enter based on candle closure. This means you wait for a key signal candle, like a bullish or bearish engulfing, to fully close. Once it closes, you enter immediately with a market order on the next candle's open. Your stop is then logically placed just beyond the opposite end of that engulfing candle. The second technique is the patient strategic approach, using a limit order to enter. Instead of chasing price, you set a buy limit order in a bullish setup around the 50% retracement level of the engulfing candle, anticipating a pullback for a better risk-reward entry. Your stop loss remains in the same logical location. Finally, for breakout traders, you can enter based on the break of the candle, meaning you wait for price to breach the high or low of your signal candle before committing. Each method has its merits, but the core principle is unwavering. Your entry must be a deliberate, rules-based action, not an emotional reaction, ensuring you execute your plan with precision every single time. So how do we know when a trend is truly exhausted and a reversal is imminent? It all comes down to identifying the definitive trend break. This chart illustrates the sequence perfectly. First, a healthy uptrend is defined by a series of higher highs and higher lows, often following a trend line. The first critical warning sign is a break of structure, BOS, where the price creates a lower low, breaking below a previous significant higher low. This is the initial crack in the foundation. The final confirming signal is the break of the trend line itself. When this happens, it signals that the underlying momentum that was driving the trend has completely dissipated. The buyers can no longer maintain control. This combination, a break of structure followed by a decisive break of the trend line, is one of the most powerful objective confirmations that a trend has reversed. It's not just a pullback, it's a change of character in the market. This is the moment you stop looking for buy-the-dip opportunities and start preparing for a potential new downtrend. And that brings us to one of the most crucial decisions after a breakout, to retest or not to retest. This is the moment that separates impatient traders from patient, strategic ones. The chart from Elephantine Global Ventures illustrates this perfectly. After a clear bullish breakout above resistance, the price has 2 paths. It can either continue soaring without looking back, or more commonly, it will pull back in a bullish retest to kiss that former resistance, which has now become new support. This retest is not a sign of weakness. It's a gift. It's the market offering you a second chance to buy on retest with a much higher probability and a tighter stop loss, placed just below the new support level. The same logic applies in reverse for a bearish breakout. A bearish retest of the broken support turned resistance is your prime opportunity to enter a short. The key takeaway is this: you don't chase breakouts. You either enter aggressively on the initial breakout candle close, or you wait patiently for the retest. This disciplined approach to entry dramatically improves your risk-to-reward ratio and is the hallmark of a sophisticated trader. This final chart from Elephantine Global Ventures brings our entire journey full circle, showcasing the ultimate consequence of a trend break, the death of an uptrend. We start with a clear uptrend, defined by a series of higher lows, or HL. The market is making consistent swing lows that are each higher than the last. But the critical turning point arrives when a HL failed. The price attempts to form another higher low, but instead, it breaks decisively below the previous swing low. This is the break of structure we discussed earlier. When this happens, that former support level, the bedrock of the uptrend, instantly flips into a new resistance. This is a classic support-turned-resistance level. This level now becomes our strategic filter for new trades. Any retest of this new resistance becomes a potential shorting opportunity, with our target now pointing down towards the next lower level. This is the essence of following the trends. It's not about blindly buying in an uptrend, but about dynamically identifying when the trend has shifted and having the discipline to flip your bias, allowing you to profit from both the rise and the fall of the market.